Alex Roepers founded Atlantic Investment Management in 1988. He's a dyed-in-the-wool value investor. Small wonder he's a featured speaker at today's Value Investing Congress in Midtown Manhattan. But Roepers' strategy is not without controversy. He joins us now. Welcome to you.
Nice to be with you.
All right, so your strategy is to concentrate a portfolio into a handful of stocks. You've probably been asked this question a bunch before, but doesn't that increase risk?
No, it doesn't. If you be very careful about finding a limited universe from which you can select your stocks, we have from day one limited ourselves to companies that are, first of all, liquid enough, second of all, avoid certain risk categories like high-tech, biotech, companies that are lacking transparency, companies that have big product liability risk, and then we want only investment-grade companies. So if you start to narrow it down and then select stocks from that universe that are trading on maybe 8 times predictable, reliable operating income, the chances for having a realized loss eventually on a position like that becomes quite remote. So we've implemented this now for almost 20 years and had very few actual realized losses on individual positions as a result of this discipline.
And from what I understand, it takes you a long time to choose a stock. An example of that is Smucker's, which you waited 15 years before purchasing. So once you do buy a company like Smucker's, how long do you hold it?
Well, we typically hold our core longs between 1 and 3 years, or whatever time it takes to gravitate from the lower end of their typical valuation range of 8 to 12, to the higher end. And so in most cases, it's between 1 and 3 years, with some trading that we do around the position during that period. But Smucker is an example of a company that has fit our general universe definition. The business mix was appealing to us, so we had it in our top 30 candidates for a long time. It just never got cheap enough, i.e. to the about 8 times enterprise value to EBIT range, until March of this year, when a number of factors, including a bad equity market, but also high amortization charges from the Folgers deal and a scare in the peanut category caused by one of their competitors. All these factors caused the stock to drop precipitously, along with a lot of other things in the market. But we were keen on getting into this one, given that it has very stable earnings. It in fact grows earnings from 2008 to 2009 to 2010, and there's not a whole lot of companies in the market that can say that. And then we were able to get it at our multiple.
Sir, you set up 4 areas to avoid in 1988. They haven't changed since then. One is tech, biotech, apparently because you don't like the risk of tech becoming obsolete. Does this mean that you're missing, companies like Apple?
We for sure do miss the tech bubbles and the tech busts as they happen. I've learned lessons in the 80s when I worked for 2 conglomerates, one Dover, one Thyssen-Bornemisza, and we were involved in some technology acquisitions and technology companies, and I realized from those experiences that it's very hard for insiders to evaluate the success of their own research and development in terms of what it might do to the money-making businesses they currently have.
Sir, why do you say that?
And also what the outsiders might do.
Why do you say it's hard for the insiders? It sounds like you're saying they're breathing their own oxygen.
Well, for instance, if you take IBM, together with Apple, which you mentioned, were very successful with the personal computer in the early 80s. But the success of the personal computer killed the profitability and the growth in the mainframe market, which was the primary driver of IBM earnings in the early 80s. And as a result, IBM stock, I believe, was down for about 15 years before recovering a new high in the mid-90s.
As a value investor, of course, the style doesn't work at every point in business cycles, stock market cycles. Where are we? How would you characterize where we are in the current cycle?
Well, today is a very interesting market post the tremendous traumatic crash of last year. In March, clearly people decided the world was not going to end, and there was a tremendous rally, and it continues to be a tremendous rally in a performance-chasing exercise, in my opinion, in the cyclical recovery plays. These are everything from carpet makers to heavy equipment makers, car companies, and related industrial plays are very much in vogue. They're doing well, and now managers and pension funds and the like looking for performers are throwing more money on it, the way the tech bubble was chased in '99 into early 2000, taking out all the liquidity out of, say, value stocks back in '99. And in this case, a lot of food companies, packaging stocks, defense, aerospace companies are lagging tremendously because they're not in this cyclical recovery area that is so popular right now. So you're looking at some tremendous overvaluation and hope baked into those cyclical recovery in industrial companies.
Alexander Roepers of Atlantic Investment Management joining us this afternoon. Sir, thanks.